Okay, so this morning we're going to talk about protecting your legacy. For those that were here last time, in fact, who was here in the previous meeting when Chris was here? Okay, good. Probably at least half of you. So the briefest of introductions. How many of you in this room know of Mark Homer? Show of hands. Who knows Rob Moore? Show of hands. Okay, so probably a good chunk of the room. So Mark Homer, probably most known for Progressive Property Group of companies, I've got a lot of time for Mark. He's very financially astute. I find him very savvy, switched on financially, and I found out many years ago now that Mark's accountant is Mr. Wilkins. And there's another entrepreneur who I tremendously respect, who is super savvy, financially switched on, and he also had the same accountant. And the latter had been with Chris for over 20 years, and Mark had been with Chris for over 10 years. And that's when I went, right, okay, I'm very much in favor in getting to know. That's the power of mastermind and connections. And needless to say, I don't suffer fools gladly, and I definitely have not had to suffer Chris. I've had the benefit of significant upside and very, very switched on all things tax. So you're in for a treat. So please give a warm mastermind welcome to Mr. Chris Wilkins.
Thank you.
So welcome back, Chris. So the theme this time, last time we were talking about capital gains tax. This time we're talking about protecting your legacy. So obviously with the recent budget, I imagine you've been very busy since the recent budget because there's been a lot of changes. As an opener, so in this session, I'll kind of lead with 3 or 4 questions, and then I'll hand over to you guys for whatever nuances, whatever specific questions you want, either on the theme or if you want to go a little bit off piece, James, well, you can do. Chris can choose whether he wants to answer the questions or not. In the context of the recent budget, Chris, what's going on? What's changed in this most recent budget that affects kind of the people in this room and their planning for handing down their wealth to future generations?
Okay, so since we last met, we've had the autumn statement on the 30th of October, and the Chancellor said that there's 2 problems. There's a they want to fill a black hole, and it's £22 billion. So I've got 2 issues with that. 1, I don't think you can fill a black hole, and 2, £22 billion sounds a big figure, but to give you an idea, that's the amount that the government thought they lost through fraud with COVID. And the government interest that they pay just on the debt, so government debt at the moment is about £2.78 trillion. The interest alone is £89 billion a year. So £22 billion is about 3 months interest. So it is a big figure, but you've got to sort of put it in context with the other things they're grappling with as a government. So on the basis that the government need to raise a lot of money, you've got to say, I like to try and have a guess at what would happen in the budget before the budget. I'm normally wrong, but I like a guess. So if you bear in mind the government raises about £790 billion a year in tax. Of that figure, 75% is the 3 big ones, which is income tax, national insurance and VAT. Now, they've already said that they wouldn't change VAT, despite the fact they've increased it 20% on school fees. They said they wouldn't change income tax. So that really left national insurance. Now, you could debate whether there's any wriggle room on that, because they said there wasn't going to be, but in the end, the government raised £40 billion in the budget, of which £25 billion is national insurance. Now, the £25 billion on national insurance, as any economist will tell you, is the person that pays the money isn't necessarily one that bears the money. So there's an article in the paper, PricewaterhouseCoopers, the biggest firm of accountants, they said that employers' national insurance, which is going up from 13.8% to 15% next April, will cost them an extra £40 million. So what they're going to do is they're probably going to outsource more jobs, offshore a lot of jobs, increase AI, cut jobs. So what you've got to bear in mind is this country has low growth and low productivity. We've got lower growth and productivity, and then a lot of European countries, France, Germany. You've got to increase growth and productivity because our debt of £2.8 trillion represents about 98.5% of the total GDP. There's virtually no wriggle room. Now, then what happens is the government have got to think we've got to increase growth, we've got to increase productivity. How are we going to do that? Generally speaking, any budget that raises £40 billion is not going to achieve that. So then the concern is, are they going to come back for a second bite at the cherry with regarding raising tax? And the reason I say that is they are raising £28 billion a year, every year over the life of this Parliament. 5 years, £140 billion. That's £140 billion on top of our debt of £2.8 trillion. Now, as you've done before, you've had your lecture, I think yesterday, on what is good debt, what is bad debt. The theory is, as a government must produce things, must build things, they'll do infrastructure. If you can do infrastructure projects, and if that stimulates the economy, then it's sort of worked. If it doesn't, then we've got an issue because it's not good debt. So the idea is what they're hoping is that they're borrowing the money to stimulate the economy. And whether the economy is stimulated or not, we'll find out over time. But the problem you've got is that if it doesn't work, there'll be more tax rises, significant ones. And if you've got a 5-year term, the main tax rises are normally in the first year. But then you'll just have to see what happens in the rest. So the rest of the taxes that we're going to be looking at today are mainly the capital taxes, which is capital gains tax and inheritance tax. Now, with capital gains tax, that increased by 20% from budget day, the 30th of October. So that means that capital gains tax went up from 20% to 24%. 24% was the rate of capital gains tax payable on residential property. Now it's payable on everything. The basic rate was 10%, that's gone up to 18%. The other things that you may be aware of with capital gains tax is something called business asset disposal relief. Now, business asset disposal relief you can claim if you have a partnership, sole trader, limited company. If it's a limited company, it must be a trading company, you must be a director or an employee, and you must have at least 5% of the ordinary shares in the company. Now, if you
is it for at least 2 years as well?
For 2 years, yeah. So if you qualify for that, you've got to bear in mind that the precursor of this was entrepreneurs relief, where the relief was £10 million. Now this is £1 million. At the moment, i.e. as of today, the first £1 million is taxed at 10%, and the balance is taxed at the new rate of capital gains tax at 24%. From April next year, the first £1 million is going to be taxed at 14%, and the year after that, 18%. So business asset disposal relief is less beneficial. It's still advantageous, but it's going to be less beneficial as time goes on. But it's still worth having if you can grab it. The other one is agricultural property relief and business property relief. So at the moment, prior to the budget, there was no limit on that. So if my shares in a trading company or my farm, because a farm is agricultural property relief, business property relief is any business. So it's got to be a trading business, it's got to be shares, partnership, sole trader. If, say, for sake of argument, my shares are worth £10 million, then the idea was if I left them to my children, then it wouldn't be subject to inheritance tax. There's no point leaving it to my spouse, because spouse and civil partners, you get inheritance tax relief. So if you're married and you leave any assets between the spouse that's remaining, there's no inheritance tax on that. But if you've got enough money to give your spouse, then the business property relief would generally go to the rest of the family, and that will be exempt. That is now limited to £1 million. So £1 million business property relief plus agricultural property relief. So if you've got a farm and shares in a trading company, it's a maximum of £1 million. Anything above that, you're getting taxed at half the inheritance tax rate, so that's 20%. So any assets in agricultural property relief, business property relief, over £1 million, taxed at 20%. Prior to the million, it's free under the business property relief and agricultural property relief rules.
At the moment. at the moment until they change their mind.
At the moment. The other thing to bear in mind is pensions. So if, let's say, I have a pension fund of £1 million, and you could say, well, that sounds a lot of money, £1 million pension. Well, a client actually came to me on the day after budget day for a meeting. We booked it ages ago, just so happened it coincided with the day after. And he said, Chris, they've pulled the rug from under my feet. I said, what are you talking about? He said, look, I'm now 70. I've been paying into my pension for the best part of over 30 years. So £1 million save sounds a lot, but from a tax point of view, you get tax relief on your pension contributions. And if you're not hit by the pension cap, you can put in £60,000 a year if you've got that much money, and your spouse could do the same if you've got the taxable profits, and that reduces your tax bill. So for the sake of argument, if my taxable profits are £240,000 and I pay £60,000 into a pension, I'm taxed on £180,000. So I'm getting tax relief in that case at 45%. So it's beneficial. So he said that 30 years ago, Chris, I was contributing into a pension on the basis that I would have it tax-free when I died. And the idea is that when you die, again, you wouldn't leave it to your spouse on the assumption the spouse has enough money. You can leave it to the kids because the pension is in a trust, and then what you do is leave it to the kids, and it's out of your estate, completely free for inheritance tax. So for this example, if I've got £10 million of shares in a trading company and £1 million in a pension, prior to budget day, both of those were free, if you structured it correctly, were free from inheritance tax. Now, you're going to get hit by tax. And so suddenly what you find is inheritance tax is going to be a massive problem. So if you don't remember anything of what I say today, the first thing to do is look at your wills. And the reason I say that is that my inheritance tax exemption is £325,000. Everyone gets the £325,000. And because I'm married, if I don't use that 325, it's transferred to my spouse. There is something called a residence nil rate ban, which is £175,000. But you can only claim that, A, if your assets are less than 2.35 million, which might not be the case given that the other items. So if I've got £1 million of pension, somebody comes into my estate, that might flip me over the top. B, I must leave my residential home to my kids, grandkids, whatever. So in the papers, they'll say, oh, well, you can claim these extra reliefs, but what if I'm divorced? What if my wife's died? What if I've got no kids? What if I've got assets over 2.35 million? I won't get the residence nil rate band for a lot of those reasons, in which case I only have £325,000 tax-free. The £325,000, if I don't use it, and if I'm married, my spouse can claim it, but not for agricultural property relief and business property relief. So if I have a company, let's say it is worth £10 million, and the shares are all in my name, that's just £1 million of business property relief you can claim. And say I started this business years ago, and I wouldn't care about business property relief because I know it's all tax-free. Suddenly I think, well, wait a minute, of that £10 million company, I'm only going to get £1 million free under business property relief. How about I consider transferring shares to the spouse? If my spouse gets it and qualifies, she'll get £1 million as well. But the problem is, when I die, that £1 million of my exemption isn't transferred to here. It's non-transferable allowance. The personal allowance for inheritance tax of 325 is. So you need to make sure that your allowances, you claim them in the right order, and you need to put measures in place. So in that case, you might say that if I've got a £10 million shares in a £10 million business, and I was planning to leave it to the kids, how about I introduce the wife into the business? So it's possible that she claims the £1 million business property relief as well. So you've got to work out what your reliefs are, how you claim them, and what order you claim them, because you need to know which are transferable, which aren't. So, like I say, the big takeaway is A, you must get a will if you haven't got one, and B, if you have got a will, after that, this autumn statement, the budget, you need to think about changing it. So some clients said to me, yeah, I'm nearly there with the will. It's about 90% there, Chris. And I say, look, if it's 90% there, sign it. You can always change it later. What you don't want to do is die intestate. And especially with the changes in the rules, you want something in place to make sure that you've got your assets are going where you want them to be going, and B, you want to make sure they're in a tax efficient manner. So suddenly you'll find that inheritance tax is an enormous issue. They say that only 5% of estates pay inheritance tax, but I would suggest that the people in this room, you're going to have an issue for inheritance tax because the way they've restricted the reliefs. HMRC are doing a lot more investigations on this. So let's just say I've got 5 kids and I've got 5 properties, and I die and I say, right, you can each have a property each, that's in my estate. Fine. Someone's got to value those properties, and HMRC is saying that people are valuing them very low. So let's say each of those properties maybe for inheritance tax purposes have been declared at £500,000 each, and HMRC said, well, they haven't been sold on the open market, so I don't know the market value of those properties. You tell me it's 500,000, but it might not be. So I'm going to have a look at this. So there's more of that activity, which keeps our surveyor clients busy, because then you have to justify that the form that the executors have filled in for the market value of those properties, which gives rise to the inheritance tax liability payable by the state, is based on the market value of the properties. So you need to ensure that everything is in place for those type of issues. So it's a big problem, and people don't realise how big the capital taxes are going to be. Capital gains tax and inheritance tax now are going to bring in a lot more money because of this. Now, if, say, May next year, someone died with £1 million pension fund, and let's say that £1 million would be wholly subject to tax. Has anyone got an idea what the maximum rate of tax would be payable on that £1 million after paying your inheritance tax, income tax, etc.? Anyone ideas what the maximum rate could be on that £1 million?
65%?
Very close. It's actually 67%. So the way it works is that if you die with £1 million pension fund, and let's assume you've used all your allowances, so that £1 million is subject to 40% tax. So
The 40% inheritance tax.
40% inheritance tax. That means that the pension fund are now obligated to pay that tax, not the estate, but they'll pay it first. So that means that of the £1 million pension fund, £400,000 is taxed, paid tax by the pension fund. That leaves you with £600,000. The £600,000 then, you have to draw it down. And let's say you leave it to, say you've got one child. If that child earns more than £125,400, that means they're a 45% taxpayer. And bearing in mind the tax bands are frozen for 8 years till 2028. So that means your basic rate tax band, your 40% tax band, your 45% tax band don't go up with inflation. So you've got fiscal drag. So fiscal drag means that if say I earn £50,000 and I say to my boss, I'll have a £10,000 pay rise, please. And the boss says, that's fine. So I thought, well, 20% taxpayer, £10,000 pay rise, that'll be £2,000 tax. Well, no, because you flipped into the higher rate. If the tax bands had increased along with inflation, then your pay rise would be in accordance with inflation as inflation goes up. But what's actually happened is that because the tax bands are frozen, you're going to go into the higher rates of tax sooner. And so now 45% tax is payable on income above 125,400. So what that means is that, say your child earns that much money and draws down the £600,000, which is the £1 million less 40% inheritance tax, that's £600,000. They're going to pay 45% tax on that. 45% tax on 600,000, 270,000, 270,000 plus the 400,000 gives you £670,000, 67% tax.
Are you enjoying this motivational talk?
That's how important this is. A lot of people don't realise how bad this could get if you do nothing. You've got to do something, and you've got to get good advice. And you've got to get your advisors make sure they're in tune with this lot and understand it. And a lot of them don't understand the interrelationship between capital gains tax, inheritance tax, etc. So what I thought I'd do is tell you the bad news first and then give you some ideas. And then, so it's not too painful. I don't want you to all walk out and hit your head against a brick wall. So you've got some ideas. So that's sort of the basic. And then...
yeah, so before, that's a couple of clarifying questions. So I mentioned yesterday, I want to have a chat about trusts and about fix. But before we do that, anything else from a first principles perspective, or any key points as it relates to inheritance tax? You're kind of giving us the lay of the land. Is there any other kind of points or changes in inheritance tax that we need to be aware of that came out of the budget?
Yes. I've got an example here.
Yeah.
This is, as they say in the trade, something I've prepared earlier. Not that I'm in the trade. I don't know if you could read this, but this is an example where I can try and sort of just get you thinking, if I can sort of give you some examples of what you can do. So we've got A Limited, which is a trading company. Sorry, I only had a red pen. It doesn't mean it's dire, but A Limited is a trading company. Gwen Smith and Rob Smith are married. They each have 5% of A Limited. Gwen is an employee of A Limited. Rob's a director of A Limited. They have 3 children, Frank Smith, who's 26, Geraldine Smith, who's 24, Neil Smith, who's 22. The reason I say that is they're not minors, because they're over 18. It makes a difference to how we're going to structure this example. I know this looks like an exam question, but hopefully some of this will affect you. So Gwen's 64, Rob is 67, and they're both going to continue working in this company. They both have other assets of £1.5 million each. So that tells me that they're going to pay inheritance tax at 40% because they've used up their basic rate allowances of £325,000. They each have £1 million of pension fund and they have £1 million of AIM shares. Gwen and Rob's shares cost them £5 each and they're now worth £1 million each. So that's hopefully some of this will resonate with you. So what I'm trying to give you an idea of is that what can we do with people of a certain age who want to try and mitigate inheritance tax? So if we go through their assets, prior to budget day, the £1 million pension, well, that was normally going to be left direct to the kids. So it wouldn't be part of their estate, wouldn't be subject to inheritance tax. AIM shares are specifically excluded from inheritance tax because they come under business property relief. So a general rule was, if I had a lot of spare cash, all I had to do was buy, I say all, if I bought AIM shares and held those shares for 2 years, then they wouldn't be subject to inheritance tax. I wouldn't bother writing this down, sir, because it's all changed on the 30th. Gwen and Rob's shares cost £5 each. They're now £1 million each. Well, that £1 million of shares in a trading company would also be subject to business property relief. Now, we know that they're only going to get relief of £1 million each for business property relief. So that covers their AIM shares. And we know the pension fund is all going to be taxed at 40%. And you can't give away your pension, I don't think. So that means that the £1 million they've got each in this company is also going to be taxed at 40% because business property relief is limited to maximum of £1 million each. And they've got £1 million of AIM shares. So the question is, what do we do? Comes back to Dan's point. How can you be proactive? Well, what you want to do is you want to try and, if you can afford it, think of what you're going to give away. Now, I can't give the pension away, but I can start giving away some shares. So if I wanted to do this, what I could do is that Rob could give his shares that have £1 million to his kids, and Gwen could give them away to the kids. Now, we say that Gwen will still continue working as an employee of the company. Rob will still be a director of the company, but they won't own the shares. The shares they're going to give to the kids in equal proportions. So to do that, you can claim something called gift holdover relief. And this is worth writing down, actually. Gift holdover relief is something where if you give shares in a trading company, it's signed by both parties, but what you're actually doing is you're passing the shares that cost Rob £5 and cost Gwen £5 to the 3 kids. And that they are, like I say, they're not minors. The answer will be different if they're under 18. But if you give it to them, what it means is that Frank, Geraldine and Neil receive those shares at Rob and Gwen's cost. So the shares are now worth £1 million, and Frank, Geraldine and Neil will receive shares that cost £10. So what you're actually doing is transferring the capital gain, so it doesn't crystallise on Rob and Gwen, it crystallises when Frank, Geraldine and Neil sell those shares. So they then have shares that have a base cost of £1 each, i.e. 10 shares that cost £1 each, and when they sell them, they will pay capital gains tax on the share.
On the gain that they make.
On the gain.
Yeah.
If Rob and Gwen have to live 7 years, so it's gift holdover relief, so you made a gift. The gift is called a pet, nothing to do with animals. It's a potentially exempt transfer, a pet. And it's potentially exempt for inheritance tax as long as you live 7 years. If they die within 7 years, inheritance tax will be payable, but possibly at a lower figure because inheritance tax goes down like that. Nothing in the first 3 years, but then it goes down to 0. So as long as you live 7 years, and Gwen is 64, Rob is 67, they think they're in good health. So you need a 7-year lag. So you may have seen after the budget that they're talking about farmers, and they're saying, well, it's just not fair because I'm not going to live 7 years, in which case this won't help me. So it's a 7-year tail. So you need to plan, if you're thinking of doing this, 7 years advance. But what it does, it avoids Rob and Gwen paying capital gains tax at all.
Just to check, is anybody planning on dying in the next 7 years? All right, good, good. Plenty of time. Plenty of time.
So that's a good point. You can take out life assurance. You may have seen that people now are taking a lot more life assurance out on this. So you might want to say, Rob might want to say, I've got potentially a 40% tax bill on £1 million, that's £400,000. How about I have a term assurance and I insure my life, and Gwen can do the same for 7 years. I need to insure it for 7 years. After 7 years, I don't care because it's gone, the bill's gone. But what you've got to do is make sure that the beneficiary of that life assurance is written into trust, so it's not Gwen. So you need to make sure that that doesn't go back into his estate for inheritance tax. You need to keep that out of the estate.
Chris, do you get the tapering relief from 4 years still on this to the 7? Does that still apply?
Yeah, so in inheritance tax, if I make a gift today and die within the first 3 years, it's still at 40%. Thereafter, it goes down to 0. So you've got to live the full 7 years. It will be less, but it goes down.
Just as a quirky side point, I've got a private client who his entrepreneur, decent sized company, but his father also has or had a large trading company. He just sold it for an 8-figure cash sum, just cashed out, and he chose to gift a lot of money, a 7-figure sum to each of his children. And then the joke was, right, basically, Dad, we're wrapping you up in cotton wool. It's like, we don't care what the hell happens. If we have to put you in deep freeze, you are living 7 years. That's the family joke at the moment.
So, if your accountant understands capital gains tax, gift holdover relief, inheritance tax, you're doing well, because a lot of them don't. The next stage is, how can we make this better? Now, given what I told you about business asset disposal relief, you may be aware that Rob qualifies for bad R because he has limited as a trading company. He's a director of the trading company. He's got 5% of the shares and has been for 2 years. Gwen qualifies because 5% of a trading company, she's an employee, she qualifies as well. However, they treat their kids equally. So Frank gets 3 1/3% of the company, Geraldine gets 3 1/3, Neil gets 3 1/3. They get bad R, they don't get bad R. So I might be the only accountant that's told you to pay a big tax bill, but if this works out right, you can save, when I work it out, over £98,000 for each child. So if you claim gift holdover relief, they receive the shares 3.3%, which have a value of £3.33. They then sell them for the market value of £1 million, and they'll pay 24% capital gains tax, because in the autumn statement it went up to 24%, 20% increase from 20% tax. However, if you don't claim gift holdover relief and Rob makes a capital gain and gives the shares at their current value, not by claiming gift holdover relief, he'll claim bad R. And on the £1 million, he'll only pay 10% tax. If he does it after April next year, he'll pay 14%. And if he leaves it after that, it'll be 18%. But at the moment, his tax bill is 10%, their tax bill will be 24%. Now, if you did that, then you wouldn't claim gift holdover relief, but you'd be saving about £280,000 tax that would be payable by the kids. Now, you might say, well, yeah, but how am I going to get £280,000? Well, we know that mum and dad have a pension each for £1 million, and we know that that £1 million is going to be subject to tax at 40%. If your pension is structured correctly, and the reason I chose £1 million is that the maximum lifetime transfer for pensions is £1,073,100. The pension limit was increased in the March budget by Jeremy Hunt, but the maximum you can take out tax-free from a pension is 25% of £1,073,100. So your pension could be above that, but then anything above that, it's taxed on drawdown. So if your pension's structured properly, Gwen and Rob could take out 250 grand each, tax-free. And then that tax-free taken out would pay their tax bills, and then that would mean that they've actually enabled that the kids will pay less capital gains tax because they receive the shares at a base value of £1 million, not at a base value of £3.33. So you save them £280,000 on that structure. Because what you want to do is, you know that the pension, say you take out £250,000 tax-free, that leaves £750,000, that if you die with the £750,000, it's going to be taxed at 40%. And then on drawdown, the kids are going to pay income tax on top of that. So even if you're a basic rate taxpayer, you're going to be 20% plus 40% on that. So you want to consider spending that as soon as possible. So you might want to, like I say, take the money out. Now, with the 750, i.e. the £1 million less the 250 you've taken out tax-free, how about we think about how to mitigate that? I'm going to take the pension out, and what I'm going to do is I've got to take it out as soon as possible and start spending it, because they've already got £1.5 million of other assets. Now, on the basis that you're not going to shortchange yourself, you might think, I want to start spending this as soon as possible. How am I going to do it? Well, if I draw the money out today, a bit at a time, and give it to the kids, do I have to live 7 years? Any ideas?
No,
it's a trick question.
It doesn't affect your day-to-day budget. So if you can do it to HMRC, if you draw it down as income, and it doesn't affect your day-to-day living, you can gift it and not live 7 years.
So that's very good, sir. It's called a gift out of income. And I've said here that both Gwen and Rob will continue to work. So if they continue to work, they've got enough income. So if they've got their PAYE income from the company, if they then take out the pension, then that is a gift out of income, because they don't need that pension income to live on, because they've got PAYE income. So then they give it away, which means you don't have to live for 7 years.
And then can't the kids then put it into their pension and get paid, and that gets marked up by the government, because you're sort of paying a marginal rate. The parents are paying a marginal rate of tax or withdrawing it. give it to your kids, they put it into their own pension and it gets...
Well, as long as they've got taxable income, they can, yeah.
And then you're sort of making off the government. If you're a high marginal rate, like say the parents take out at X rate, you give it to your kids and then they put it into their pension and it'll get grossed up again.
Well, don't forget that the parent has probably suffered 45% tax on drawdown. So it's unlikely that, so if I've got £1 million pension and I say I take that over 10 years,
Right.
I've suffered £450,000. I'm only left with 550. If I give it to the kids at 550, then they're not going to be able to get the tax relief back on the 45%. But the parents have hopefully had the tax relief on that. So when I was doing my what's going to happen on this budget thought, when I was looking in the mirror, you think, well, at the moment, if I contribute into a pension for most of my life, in theory, it's possible to put that in and get 45% tax relief. When you retire, you're getting 25% of it tax-free. And I thought, well, they might stop the 25% tax-free. If I died before age 75, then my kids wouldn't even pay tax on drawdown. If I died over 75, then they would. But the idea was that I could get tax relief at 45% on the million. I'd take 250 tax-free, leave 750 to the kids, and they might be basic rate taxpayers, and I would have had tax relief at 45% on that all my life. So you could see there were advantages, but I never thought they'd go this extreme. They could have cut down other things. And like my client said, who's 70, he said, one of the reasons for investing in a pension is that on the premise for the last 30 years that it will be tax-free on death, because I was going to leave it direct to the kids. So now that 30-year tax planning has gone out the window. Well, that's what happens in budgets. So what I'm saying is a lot of this stuff, because the numbers are so big and you probably don't realise how big they can be, is that you've got to make sure that you're doing the tax planning. And when you speak to your advisors, your accountants, whoever, you need to make sure that they understand capital gains tax, business asset disposal relief, income tax, inheritance tax, and then work out what is best for you, because the numbers can get pretty scary.
Can I just interject, Chris? I mean, here's a point. I want to chunk us up, because I do think it's helpful to illustrate with an example, but I'm also glad that a few people's eyes are glazing over. So I want to probably chunk us back up to a kind of key principles and conceptual level. I want to talk about trusts and fix. But here's the point. If you're kind of struggling with this, I don't get this. You don't get a pass. You do not get a free pass. Ignorance is not bliss. Ignorance is a huge, monstrous fucking tax bill. And I've got an elderly relative in my family who insists on burying their head in the sand and going, you know what, almost you sort it out after I die. And I've said to her, I'm like, you do realise you're leaving your kids to have a big fight. Big problem, big fight, and it's hurting them. You go, oh, it's too complicated. And we are going to talk about how do you get advice, how you get a good advice. But ultimately, I'd argue if you got advice and just kept your wits about you a little bit, you'd be better off than not getting any advice at all. But if you just abdicate, if you just go to any old advisor who claims to be able to know this stuff, you need to have your wits about you enough to have a few questions. So if all you got from this session, I'm not expecting you, Harry, to be able to quote inheritance tax codes and what it all means, but to get a few kind of questions to ask, the right questions, and understand what it means and challenge. And you're not just going to go to some advisor, pay a fee, and then just sign a bit of paper and go, well, that's all taken care of. I think of responsible. Remind me how many of you in the room are parents? I think it's the responsible thing as a parent to really get your shit together. Otherwise, you're just leaving a problem for your kids. Like a mess, or like trusts that don't work, or all kinds of stuff. And the rules change. You don't need to understand the rules, but you need to be aware enough to be able to ask the questions. That's the intent. So with that said, Chris, we have a high level, maybe not granular on trust, because they're a very complicated beast, but talk to us about trusts. Does anyone here have a trust, by the way? Yeah, or uses trust? Okay, a handful. Okay, talk to us about trusts. when can they be useful for inheritance tax purposes, or what kind of key points that people in here should be aware of?
Okay, so there's a couple of ground rules with trusts. One, you've got to bear in mind that
What is a trust, actually, first of all?
a trust is a separate entity that holds assets that you can't benefit from. And so one of the things that people think is that there's loads of stuff in the press about farmers after the budget. And one of them says, well, what I'm going to do is I'm just going to stick my farm into a trust and that'll be fine. But you've got to bear in mind that generally a gift into a trust is subject to a lifetime inheritance tax transfer, and that's subject to 20% tax. And there are
What does that mean? When you transfer it in, there's a tax, or
when I transfer it in.
Okay.
So if I gave £7 million to my son today, it doesn't trigger a tax charge. It's a potentially exempt transfer for inheritance tax, a pet. If I live 7 years, no tax will trigger on me. If I put £7 million into a trust, then generally that's going to be subject to a lifetime inheritance tax charge, which is half the death rate, which is 20%. You've got to be very careful that you don't trigger a settlor or interested trust, because there's some reliefs that you can claim that won't be available. So what that could mean is that if I gave, say, a property to a trust and that property is worth £325,000, then £325,000 is my inheritance tax exemption, which you can do and it wouldn't trigger a tax charge as long as I've made no gifts subject to inheritance tax in the last 7 years. And if I live 7 years, then in 7 years' time I could do another one because it's £325,000. Above that figure, you're likely to trigger a lifetime transfer for inheritance tax. So if I make a gift into a trust of £1,325,000, it's likely I'm going to pay 20% tax on the £1 million. If I put it into a trust, I can't have the use of that asset. So in this article I was reading, the guy said, I'm going to put my farm into a trust. But that means he can't use the farmhouse. He can't be on the farm because it's the trust asset. So the government have this thing called a gift with reservation. A gift with reservation is that if you put something, if you give it away for inheritance tax, then you can't benefit from it. So you can't put a farm into a trust and still live in the farmhouse because it's the trust's asset, it's not your asset. So the thing about trusts is that you've got to be careful. Any income from a trust, the lowest rate of income tax is taxed at the highest rate that an individual pays, i.e. 45%. So the income will be higher. And every 10 years, there's an annual tax charge of 6% on the value of the assets in the trust.